Dear colleagues, good afternoon. Thank you for accepting our invitation to this discussion. As you may know, yesterday the Board of Central Bank decided to remain unchanged the core interest rate, and the monetary policy and transparency reports were published yesterday as well. And we will now discuss the monetary policy outlook. Mr. Avatisyan will dwell on it. We enjoy the presence of Mr. David Naupetyan, a member of the board of the central bank, as well as Heikki Karapetyan, Monetary Policy Directorate, one of the Monetary Policy Directorate heads. Let me remind you that we broadcast live, and following the presentation you may ask questions. Please turn on the mic for translation purposes. Thank you. Good morning. Good afternoon. I will submit to you the monetary policy outlook, which essentially encompasses the yesterday publication's main highlights, and we will have an opportunity to discuss it based on your questions. This is Q1 monetary policy report essentially. As always, let's start the discussion with the developments in the external sector and main partners and leading economies. Here in the USA, high economic activity continues, and in the labor market the tension is still present. The inflationary trends have slowed down. The trend is apparent, but essentially weakening labor market conditions display signs of slowing, and there are more fundamental inflationary pressures, and sticky price inflation remains high and still is away from the target indicators set by the Fed guidance. This generally displays that the positive inflation background is not yet overcome fully, and in these conditions naturally there are certain risks coming about, mostly in view of the other policies. Customs, fiscal policies include certain risks that essentially have opened up more uncertainty in the American economy. On the left hand side there is the assessment of the so-called rapid indicators, where even in the United States there is a possibility of several scenarios of slowdown. The uncertainties have significantly increased here. The main uncertainties pertain to, like I mentioned, in the US with the trade, migration, fiscal policies, the whole palette thereof, which the US administration is discussing as we speak through various public communication channels. Most of them, as you see, are still underway, being discussed in the pipeline, deferred, or replete with uncertainties. The only segment is the tariff policy imposed on China. Along other dimensions, whether it's tariffs, migration, or reducing taxes, still have lots of uncertainties as to which way they will go. This essentially opens up not only the prospects of economic growth, but even American demand, long-term debt, and long-term interest prospects. Especially if we look at the tax policy, the various proposed or discussed packages in general in the forthcoming 3 to 5 years may allow us to assume that the American debt may increase up to 30% points, which will pose a significant issue both in terms of long-term interest rate, the stability of debt. Of course, stability of debt in case of America is a relative notion, but naturally the increase of burden of the debt and its price may have a significant impact. Naturally, these policies assume also, among other things, since the design pursues potential positive economic impact, which may mitigate the effects I just mentioned to some extent, but in general terms, in the longer term, in terms of debt and potential, it still contains lots of uncertainty. Migration policy naturally is declared, and if we do de facto monitoring of the course of this policy, naturally the impact in real life is still quite weak of what's been announced, but naturally there again remain uncertainties as to how aggressively these policies may proceed. This may create significant issues with the US labor market, especially in those segments thereof where migrant labor is more engaged, mostly low-skilled labor, which in terms of internal demand and inflation is the most vulnerable segment and would lead to the biggest problems. Naturally, these are the main issues that at this stage lead to the biggest uncertainties in the American economy, and this not only for American but also global economy. If you were following yesterday's report, we discussed two scenarios of the trade impact, not only of the USOFA but also global economy and the impact on ourselves, both inflationary and deflationary. Both dimensions may contain possible developments. In the A-type scenario, where the interest is higher, it was mostly anchored to long-term interest behavior of the US, and in terms of demand and tax policy would be mostly incentivized, and it could also have a short-term inflationary background, considering that the US economy still has not overcome this background fully as yet. More A-type scenarios may come about. Of course, disruptions of value chains may also create inflationary backgrounds. Concurrent with that, in our discussions we looked at scenarios which may have more deflationary background, and higher interest rates may have lower trajectory. This pertains to the situation when the tariff policy, especially for final consumption goods, may disrupt for third countries. By disrupting trade between two countries, they may create positive surplus supply for third countries, and surplus supply may form deflationary scenarios, which is most likely, especially in the mid-term horizon. Both scenarios at this point are quite possible and are worthy of monitoring. Our other major trade partner, EU, we see here a slowdown, almost zero growth persists. The main issue here pertains to the structure of growth that is quite differentiated. In the potential structural segments, there have been 4 to 3 years significant issues. Concurrently with that, the external demand-fed sectors, those who feed on tourism and the countries that benefit from tourism, the southern countries, Italy, who have more of this structure feeding on external demand, tourism flows that are economic drivers. In this segment, there is more positive developments, which also is expressed in the inflationary behavior in the top right chart. When we look at the total background of inflation is close to target indicators, 2.5 to 0.4, but services inflation remains high. In this respect, there is a similar situation in the US of A. If you remember, it was a similar situation in Armenia until 2023, end of 23. This expresses the uncertainty which from the monetary policy perspective and could be determinant for the ECB policy, depending on which governance issue would be prioritized by the ECB, considering the demand, labor market environment that are still inflationary. Concurrently with that, the inflation that in imported terms is low or is within targets. We already saw that the ECB has reduced to some extent the interest, which prompts that in managing those scenarios, the inflationary behavior is what they will track and monitor. But naturally, when the demand risks are substantial or maybe stronger, we may in the future see stagnation, or in some situations, if the shock strengthens, also reversal. Although this is one of the unique, interesting, and perhaps also bad shocks in terms of managing when the structural growth is zero, but on the other hand, the demand has a likelihood or possibility of high inflationary pressures. From the monetary management perspective, that is a sophisticated issue to address and resolve. The Russian economy developments, you know that for a long time the inflationary background persisted and grew in the recent period. Inflationary expectations also contributed to that. We of course discussed this, especially in the fiscal policy overall impact, which led the whole environment into inflationary domain. But in the recent period we see a certain stabilization, especially in view of the most recent developments that were reflected in the behavior of the exchange rate, and in terms of inflation per se, as well as inflationary expectations, could have conveyed a certain positive signal, although the risks of the demand persisting are material. Even if in the possible scenario when these two, Russian and Western confrontation or tension, is resolved to some extent or gets on a positive track, even if this scenario were to materialize, it would assume either the termination of the active stage of the war, it will assume capital expenses, investment projects, which will also in terms of demand still have a positive impact. With all this considered, in all these scenario discussions, naturally we could still acknowledge or maybe think that the issue of demand and inflation still will not be deemed to be overcome. Even the Russian central bank most probably will still take certain measures towards this direction. That's about the general background. And if we reflect on the international commodity markets, what do we observe here mostly when we talk about the main demand? It's China, EU. We talked even about the possible scenarios of the USA. The demand risks are mostly deflationary. The main risks that may come about will pertain to inflationary environment on food and commodities, but on the side of the supply and all of the uncertainties in disrupted supply chains, value chains, and trade wars contain more inflationary components, which we've been observing for a while and talking about for a long time. Essentially about these commodities, the environment is such that the main drivers may be supply shocks. This is already observed mostly in food supplies, dairies, mostly oils, vegetable oils. because of various supply issues. This inflationary background is substantial, which will transfer also to the Republic of Armenia in our inflationary behavior. These two groups of goods already have a certain expression in inflationary pressures. But we need to once again, if we were to assess the drivers, we see that mostly it's the demand going downward pressures or risks, and in supply the increased uncertainties will result in more volatility and more inflationary background. The same pertains to commodity markets, other segments such as energy and fuels. These are mostly subject to what political and trade issues that also display a lot of volatility. This will continue, and there is and to identify a single trend would be difficult, or even not necessary, as one may say. If I summarize the external sector, we think mostly it will be a weak inflationary background. The scenarios vary, mostly downwards. Weak inflationary and weak demand scenarios come from developments in the EU and China, which we already covered. As for inflationary scenarios, let's put it this way: A-type scenarios, which imply a higher interest rate by the central bank. These are mostly determined by USA fiscal trade policies, the entire background. US per se maintaining longer higher interest rates. About Russia, the main risks I already identified. Let's move on to Armenian economy and our main observations. Naturally, here the first thing that comes to mind is the capital market, which is important also in view of our monetary policy. Neutral interest rates is the risk premium, the country risk premium, which maintains the relatively positive environment which came about in the recent years, and the risk premium assessment in the capital market has a trend to decrease and it's at low level in our assessment. That's positive, but to some extent it may be possible that it may go below baseline, which in case of possible scenarios may be adjusted. If you remember, the board identified this, and at this stage as well, this cycle as well, the risk premium may enjoy the possibility of increasing potentially. Here there are several positive phenomena or scenarios that we may refer to, which pertain to the following. At this point in time, when the US has more of issues than developing countries, the developing countries have encountered the reality which historically is quite positive, but historically also unprecedented in our assessment. This is the phenomenon when the issues are in the United States, and even if in the possible scenarios of maintaining high interest, there will be no substantial risks of capital flight from developing countries. If we look at the risk premium, there is even more possible trends that persist, which leads us to think that, to put it mildly, a turnaround possibility is not unthinkable, depending on how soon the United States will resolve its issues, or the international financial capital risk-free assets would be revalued. In any case, this background persists, and in the future it will create a positive background for the capital market of both us and the developing countries. Domestic economy development still persists the high growth background. In our assessment, we have approached the assessment of our overall growth potential, but it's still high in our view, and it's 5 to 5.5%. We closed 24 by economic growth 5.9. Early this year, the economic growth activity is also high, 7.1%. But we in the board also identified in our discussions the structural peculiarities thereof. In the past, in the structural peculiarities, we emphasized the so-called re-export on short-term factors. Now this was augmented by, from the risk perspective, augmented by construction sector concentration. We observe in the construction contribution to the general growth is 0.9 percentage points, but concurrently to that, financial sector and real estate transactions also contribute. The share of the financial sector, we know naturally, is mostly dependent on mortgage activity. So essentially, certain centralization is observed, especially in the last quarters. There is concentration in the growth with respect to construction transactions, which poses certain risks towards the overall structure of growth. On the other hand, construction per se is contributing to potential growth as a sector as a whole. And if we looked at the recent years, our investments or cumulative gross accumulation in the GDP has increased, which feeds on construction, which is positive in terms of our future potential, maybe a positive signal. Alongside all this, naturally risks along those scenarios may go different ways, and we will speak about that shortly. About re-exports, we talked already. Picking up with construction, especially if we try to emphasize all the trends that we've seen in the recent stages. It's mortgage lending in December. There was a substantial unprecedented activity observed, determined by the imminent termination of the public program of return of the income tax in the metropolis of Yerevan, which brought about and shifted the demand towards December. As a result, in January and February, naturally there was a certain slump and low rates of mortgage lending, but they still remain. There are several trends that in our assessment we cannot view it as a collapse or a significant adjustment. Pertains to the fact that the project moves out of Yerevan towards the periphery. We see there is more activity in increased construction in the provinces, which is positive and will mitigate to some extent in this transition period any acute turns. Alongside that, it's obvious that there are some programs that are still underway, and even if this program is terminated in Yerevan, in construction and mortgage there are, even in Yerevan, projects that continue, are still underway, and these are the two factors that essentially may allow us to say they compensate or mitigate the possible risks of acute turns in here. In our perspective, monetary perspective, in these developments, we look at the possible scenarios of adjustment, even abnormal adjustments, and the possible macro impact on the demand, which in our previous monetary report was also covered in one of the model scenarios, so that still persists as a risk scenario, mostly relating to the two phenomena when in this stage of adjustment. Both our wealth effect and income effect may have a more impact on the demand. Why? Because broader strata of the general public are involved in the real estate market, not just through employment but also in the rental market and in this as more of wealth accumulation. So this affects macro effects on the demand may be substantial in this stage of smooth adjustment and come up with a certain negative demand for background. If we look at the external demand, which up to 23, beginning of 24 was the main locomotive of economic growth, beginning end of 23, beginning of 24 we saw a certain plateau, stabilization or adjustment that is still underway, and it gets almost close to a balanced state where the influx of tourists has stabilized after the high growth in 22-23. Their behavior is already stable, and this is expressed in the tourism-related inflationary behavior, whereupon there is a certain slump or stable inflationary background, which means that the segment of external demand essentially has mostly been adjusted and is in the neutral domain. Concurrently with that, non-commercial remittances. In non-commercial remittances, naturally we know that we have a low influx of remittances, so there is a certain slowdown for quite a long. Our hypotheses remain valid here. In the background of most recent developments, we look at various scenarios here. The hypotheses pertain, let me remind you, to the phenomenon when we were attempting to gain an understanding. Of course, the role of remittances in the economy has substantially shrunk, but in demand part it still may have an effect. The main issue was whether this was a result of a fundamental decline in labor migration, or maybe it's other issues, even maybe statistical glitches. In migration, the main hypothesis was that between Russia and Armenia, the gap in the wages or the forex has shrunk, which reduces the migration pull factors. We saw that in 22-23. In 24 the gap came back to some extent, but it's still way below its historical peak, which is a restraining factor on migration. On the background of most recent developments, there could be different scenarios. I already mentioned that positive demand in Russia or capital in the event of positive capital investment and ruble appreciation, we may see the pull factor developing further, which may result in a new wave of labor migration towards Russia. The seasonal migration that has weakened may get back on track. Our questionnaire surveys that we conducted end of last year, beginning this year, come to attest to the fact that in seasonal labor migrants, the uncertainty among our compatriots is quite high. They're not yet made up their mind whether they will leave or not. About 50% of respondents simply fail to state clearly whether they have plans to go seasonally or not. The uncertainty was mostly anchored to Russian economic policies that may apply to migration. In this respect, we have, even if there is a positive development background in Russia, this uncertainty about new migration flows remains, and that will also have an impact on remittances. The other hypothesis we discussed also in the past pertains to the structure of those transfers, remittances, cash versus non-cash. Our survey demonstrated that the weight of cash has significantly increased in this composition, which essentially contributes to the hypothesis that this reduction, which mostly were measured statistically through the banking system, now we deal de facto with extra banking transfers having increased to some extent, offsetting the trends that we observe in statistics. 30 to 40% decline maybe is not real 30 to 40%, but maybe 20% decline is what we're dealing with, which provides a more accurate idea of the remittance flows. Both hypotheses remain valid, but the scenario, in scenario terms for us and for the general economy, it would be more appropriate and substantive to look at the possible migration scenarios that may unfold, and we already referred to the uncertainty background here. Domestic demand, naturally the main risks have accumulated in the accelerated rate of growth of lending. And the question is, this creates additional positive domestic demand background in the situation when external demand is mostly stabilizing or decreasing. As we mentioned, this is one source that we'll look at, and it will have a significant impact. We also know that this mostly depends not on the overall economic demand background, but more likely by construction sector and its ancillary developments, macro effects. Both mortgage and consumer lending, according to our assessment, are mostly determined by activity in the construction. In business, we also see that business lending to the construction is the biggest mover and shaker. So this is mostly an additional demand background shock or signal that is conveyed for the development of domestic demand. As for its prospects, this would naturally depend more on the developments in the construction and its ancillary macro sectors, which we already looked at. The other sector that's important to understand for possible risks of domestic demand or uncertainties thereat pertains to savings that have accumulated in 22-23. Starting with 21, have increased, as you see, and have exceeded our historical indicators. The main risks here pertain to whether the savings are creating a new balanced situation, conventionally speaking, whether the society or the economy has embarked on a new level of wealth, therefore a new level of savings, which is more typical for more affluent society. Is this the new balance, equilibrium, or is it just a result of geopolitical economic uncertainties and uncertainties about the future incomes? What's the difference between these two alternatives? Quite naturally, from the perspective of demand background and monetary policy, it's very important to distinguish between these two. It's more quote-unquote dangerous scenario when it's determined by the second alternative, that is short-term savings based on the current positive income in view of the subsequent uncertainties. In this case, it may possibly fully be infused back into the economy, create additional demand, and we have to be ready for such a development. This is the main risks associated with the savings, and we'll monitor it. On the fiscal policy developments, naturally in 25 we already have stated budget programs. Quite a high increase in deficit is projected in the government program. It is deemed to be an incentivizing impact. We look at several scenarios depending on, first and foremost, the structure of the budget expenditures. Secondly, determined by the possible tax policy development scenarios, and as a result, both incentivizing and restraining impacts. We discussed this at the board. Both scenarios were deemed to be both likely and controversial in terms of our policy. If we reflect on these, one pertained to the tax policy scenario, whereupon tax collection takes place with some glitches, which we had early last year, although it improved this year towards the positive side. But in any case, these risks persist, and on the background of the expenses policy, the planned tax incomes may slow down, determined also by negative risk scenarios taking shape in economic growth. Of course, in the high expenditure, high deficit budget, there will be more of a higher demand environment in 25. Concurrently with that, we look at scenarios which pertain not well. Naturally, let me tell you that we looked at the possible scenario at the higher budget deficit being more probable, which fits in the same logic, naturally. Concurrently with that, we looked at scenarios that have significant restraining effects, mostly pertaining to capex structure specifics. If we look at mostly which way the expenditure grew, mostly planned in the draft budget, they were mostly capital expenses. If we look at the breakdown of capex, they were mostly in the law enforcement, which do not have a big multiplier effect on the demand in the economy. If we filter this out, we deal with the budget, which has an increase in deficit and expenditures, but in macro terms, they may not incentivize demand. And on the same tax background, the planned tax background, it may have a certain restraining effects essentially on our economy. So both of these scenarios are possible, probable, and have been considered. These are the A and B type scenarios that we discussed. And reflecting on the labor market, we mostly acknowledge that here essentially we are have approached an equilibrium, which is reflected both in unemployment, which shrunk in 22-23 on the background of great relative background. It's been already adjusted in 23-24. It's close to an equilibrium level, which is also reflected in the behavior of wages, which has essentially stabilized. Zero inflationary background we had in 24, and it's close to the potential growth, which means here again in the labor market we do not have any pressures originating therefrom. Although in the deliberations in the board we looked at scenarios Whereupon, on the background of inflationary expectations, the labor market in terms of wages still had probable growth scenarios feasible, but on the background of inflationary pressures rather than demand environment. If I reflect on what we have in inflation, in 24 almost completely the sticky prices, non-export prices, has been pretty stable, close to the target, which means that the demand inflationary expectations are mostly in the neutral domain, and the main driver of the inflation that kept us below the target pertained to imported food stuff in the right hand side chart. 8 to 10% of price falls in imported foods in 23-24. Currently we have a growth of inflation up to 2.5%, which is also determined by the quick comeback of the imported food stuff inflation, which you may recall I mentioned it's vegetable oils and dairies, mostly butter. It's the inflationary pressures transmitted from the external market in these imported foodstuffs. Of course, in the recent months there was also some seasonal goods that were slightly deviating from normal inflationary developments. There are various hypotheses about seasonal shifts and whatnot, but they're not too significant yet. But they're worth to be monitored, which we keep track of. What's our main message? Yes, in terms of inflation, essentially we may claim the demand or inflationary expectations is neutral, but volatility both upwards and downwards may take place, considering in all of the international commodity markets imported inflationary developments, both upwards and downwards volatility may result. If we look at inflationary expectations, we continue to acknowledge certain positive developments here, more stability of late, but the uncertainties are still pretty high and continue to remain as such. In our assessment, naturally, a big chunk of this is not dependent on our economic or monetary policy uncertainty, but is more of a factor of general uncertainty, geopolitical uncertainty driven. As for the remaining indicators, if we look at them, these are mostly related to the risks associated with inflationary expectations. Most of those highlighted in 22-23 have been neutralized. This is also reflected in the current position, in our assessment of the current state of economy, which is mostly neutralized if the GDP gap is zero. In the recent quarters, the economy is more in equilibrium, both in inflationary, basic inflation, as economic growth, potential, or labor market equilibrium being hovering on neutral. This is also expressing, according to our view, the neutral rate and monetary policy position, which at this point in time we assess to be neutral. The monetary policy also, in terms of economy, doesn't have either restraining or incentivizing positions. The same could be stated about the real exchange rate. It's close to the neutral. As for market expectations, mostly you or your colleagues, it's your expectations of economic developments, especially about our monetary policy rate. The expectations from yesterday's decisions were that 54% thought it would remain unchanged, the policy rate, which is what the board essentially did, and 46% thought that it will be reduced by another successive step. By the end of the year, there are still some expectations towards reducing it. And essentially this describes an environment which essentially, according to the market participants, the rate is close to the end point of normalization. The economy, according to our interpretation or the market assessment, is that both the economy is in equilibrium. In inflationary part, the issues have been overcome. Mostly inflationary expectations are slowing down and are already close to the norm. Essentially, the economy fully is close to its potential or an equilibrium environment, and in this term, the assessment of the market participants of our monetary policy is that it gets close to its normal course. And if we reflect on the transmission of the monetary policy to, if we look at the curve of returns, yield curve, this is technicality with respect to the market, which we've discussed in this auditorium. If we offset for the volatility, the main message here is that the expectations that we saw expressed by the market participants is reflected in the yield curves. In the recent period, there have been no significant volatility, which means essentially we're close, the economy is close to neutrality or equilibrium, and also that the new shocks interpretations are also mostly balanced in terms of risks. Let me reflect on in changing the inflation targets and its possible impact. In our assessments, the market players display something that we deemed important in monetary decisions and policy terms. Reducing it from 4 to 3%, the target, the market participants think that in the longer term no such rapid adjustment has ever taken place, which means the main message we receive from the market players is that they have certain concerns about whether the central bank will be able to deliver on this 3%, or is it more for a medium or long-term prospect, and at this point in time they will have more tolerance for higher inflation, expressed in the midterm expectation being not 3 but 3.4, 3.5. From credibility perspective and persistence of monetary policy, this is an important signal for us, which also reflects in the yield curve, which essentially claims the long-term segment has responded insignificantly to this. Why is this emphasized? This is also an important signal in terms of, yes, from the monetary perspective, policy perspective we knew, but it was just a testing to it that we need to be more persistent in our actions, which means in the shorter term our efforts have to be multiplied had we been more credible or enjoyed more confidence in our statements. So this is, in policy terms, needs to be taken account of. We need to exert more efforts in being more persistent. And on this background we looked at scenarios that were discussed in the... I already reflected on most of them. Most of them pertain to A-type scenarios, which assumed higher interest rate compared to market expectations. These scenarios mostly pertained to the fact that the United States, it was possible for interest rates to remain for much longer than the expected environment. We've talked about that, both in policy, geopolitical and economic environment factors. The other pertain to the global economy environment in general. Demand emanating from the Russian market and the United States demand, and certain supply shocks were also deemed to contribute to it. Essentially, in our yesterday's deliberations, Mr. Nalpetyan will dwell on it further. In our yesterday's deliberations, the board reflected among these scenarios more on the risks emanating from the stagflation or supply risks, both globally and in Armenia. High inflation, low growth background, and this is more of a concern as a risk for the board.
Stagflation and demand-driven scenarios were discussed, and the type B scenarios, which are the lower rate trajectory. We mostly spoke about them already, driven by external demand, Europe, China, broader external demand. I spoke also about fiscal policy, potentially more contractionary scenarios, and our economy, and the potential risks that can develop negative demand trends. I did not say that in the last stage. We see also how the non-tradable price index slowed down in the long term, which can be a stimulus for the demand, influence of demand to create a negative trend. Those risks were also discussed. And as to the supply side scenarios, as we discussed already, one of them was this: as a result of trade policies, third countries such as ourselves having a more positive environment inflation-wise, so Chinese goods, other goods, European goods seeking new markets, having lower inflation or potentially deflation. And our two typical scenarios. These are the typical scenarios that relates to the ceasefire, Russia-Ukraine ceasefire, and the positive potential development in Russia. That scenario would create more of a positive external demand environment for us in terms of remittances as well as tourism. In the board we discussed in particular, and we also discussed generally, this in terms of demand for Armenian goods, and our currently neutral GDP gap could open up, and it's an external demand shock, so naturally some or most of it could be absorbed by the more appreciated exchange rate. But parallel to that, the inflationary environment, as we saw in 2022-23, the inflationary environment, the inflationary expectations could create a positive backdrop, which monetary policy wise would also imply a somewhat higher interest rate scenario rather compared to the current situation. And our type B scenario in the report concerns the situation in which this high uncertainty in the US related to economic policies could create problems for the American economy and global demand delays, postponement of demand and the investment projects, and in the asset markets, asset price adjustments resulting in the contractionary impact of demand. With this background, this is in a way the negative external demand shock scenario for us, which is the opposite of what the earlier scenario that I presented, as well as the exchange rate, the GDP gap, demand environment, and inflationary expectations. Which could imply a lower interest rate trajectory. So to conclude the scenario, these are all the scenarios. I'm grateful to you. I presented the main messages, the main scenarios, and the categories of uncertainties discussed in the board in the final stage served as a basis for monetary policy determination, and the board's decision is to keep it unchanged because all scenario risks were considered by the board as balanced, their probability and their impact, and since in line with the market expectations, this decision is in line with the market expectations, meaning that the market expectation at this stage was to keep it unchanged. I'll stop there. Thank you. If you have any questions, go ahead. I'll be happy to answer. Thank you. Questions, please introduce yourself and use a microphone. Narzuman Talakan, Ameria Bank. Lots of factors were mentioned, including the central bank's assessment of these factors. So if we were to divide all these factors, we would get three categories: external factors and their impact on Armenia's economy and on inflation; internal factors driving inflation; stiff prices, their trends, the labor market as the second category, and then the current economic growth structures and the uncertainties for future growth due to the current structure. The question is this: compared to the February board, in these three categories, which assessment of the central bank has changed? How has it changed? Resulting in the board departing from past decisions to reduce interest rates, and this time in this board deciding not to reduce. And the second question, probably a supplementary question: what impetus, what stimulus did the board want to give to the market participants? The decision to keep interest rate unchanged, does it mean we're taking a break, making a relatively longer term assessment of the impact of past decisions on the economy, or was this a decision that the central bank's policy, interest rate reduction policy, direction is not changing, but given the already current levels of the interest rate, subsequent changes will be much slower than they were in the past? Thank you. Thank you for the question. We don't lengthy discussion. I'll start with the second part of your question. By keeping it unchanged, now we're not saying that this is a pause or that the process we had until now of gradually reducing the refinancing rate stopped as of yesterday. No. Rather, we're saying that at the moment, type A and type B risks, as Mr. Avedisan also pointed out, at the moment they are balanced, and the likelihood of there's a likelihood of them materializing is quite evenly assessed. So the board unanimously agreed that the interest rates should be kept unchanged now, given in particular also the environment that exists now, also thanks to our policies, given also the current level of inflation. We think that currently there is a comfortable environment for the central bank board to take that pause, for us to be able to continue to observe these uncertainties, to see how they materialize in the near future. As to the February decision, I would just say that the uncertainties and the risks that we saw, that we examined during this session, we discussed them, most of them also in February. It's just that back then in the board we had the majority opinion that B-type risks, the likelihood of B-type risks materializing, was slightly higher, and that was the reason why we reduced the interest rate. Central Bank, as much as we may say that A and B type scenarios are based on risks which are currently relatively more balanced, and this may sound more like a technical question, but I'm really curious about it. When you look at the market expectations vis-a-vis the potential response of the refinancing rate to the A-type scenario and the B-type scenarios, they're not symmetrical. So this is more of my professional interest. Does that mean that in the B-type scenario the interest rate reduction would be greater than under the amount of the increase under the A-type scenario? Does that mean that in this the illustrative scenario that's the case, in another illustrative scenario it might have been the opposite? Or does it generally mean that the B-type scenarios, with the B-type scenarios, their impact on the economy would be of a much greater scale, and that's why a greater interest rate response is needed or warranted? Or perhaps it's also because it's also related to the anchoring of the inflationary expectations, that if in case of reducing, a sharper response is needed, in case of increasing, not as much. And that's one question. And my other question has to do with developments in the real estate market. I'm interested here in your potential assessment of now the recent obvious decline. It's still moderate, but there may be further escalation. What is its impact on the supply side of the economy? What is your estimate for the mortgage markets as well as construction? On the production side of the economy, and from this point of view, do you think it's likely that the macro potential, there can be some coordination of monetary policy with macroprudential policy to give a more effective response? I'm saying, and maybe you think, maybe your analysis supports the view that it would be the proper response, the macroprudential policy response would be the more appropriate one, and monetary policy-wise obstacles would not be created. Then the other comment, when we look at the increase in mortgage lending, it's a bit of a technical classification, and it includes also the renovation loans. That they look somewhat differently, but it comes closer to your flow traffic post-December. Disbursements are quite low, although relative to 2024 it's not as significant yet, so there's a demand vacuum here. And then when we say that we're close to the economic growth potential, numerically perhaps yes, but you and the board members, in your analysis, it's quite obvious that the underlying uncertainty, structural uncertainties, as to whether it would not be more appropriate to avoid the use of the word potential, because the underlying risks are actually much greater, that our numbers are close to the potential. It doesn't mean we're growing at the potential rate. Thank you. The first part, you're right, this is, as you said yourself, this is more typical of this typical scenario, not that it's assessed as a B-type scenario or monetary policy related to that, that the response would be much sharper to demand. And we're presenting the typical examples. Go to the previous stage, you will see a bit more symmetry, or even the A-type scenario in terms of longer term interest rates, a much higher scenario than under the B-type scenario. But it really depends on the scenarios and on the examples. So the board's observation that the discussion was more balanced, if we try to examine all type A and type B scenarios in terms of their probability and their monetary policy impact and magnitude, they're fully symmetrical in terms of the market expectation, and that's what balance means. Otherwise, in the board discussions, we had this situation as well. I think two rounds ago, where the B-type scenarios were more prevalent, so it was more of a downwards distribution. But now these are just typical examples, so that's technical. As to real estate, the real estate markets, I believe in the previous round, our typical scenario was related to the real estate market adjustment and potential microeconomic impact in scenarios. I mentioned a few pathways, but the structural potential, the supply impact, the potential related to construction, which from the point of view of monetary policy is not of great interest, but was of much greater interest is its impact on demand. Unlike 2008, for instance, where there was a similar situation, adjustment in the real estate market. Currently, it is our assessment that the real estate market adjustment is a much greater macro effect in terms of wealth and income than in 2008, because there's greater public involvement in terms of the mortgage burden and ownership, and the rental market, and the commercialized real estate. In all respects, our macro effect now is much greater than in 2008. That's why we're interested in this scenario. So our observation is that it must be a proper gradual adjustment, but the macro impact in terms of demand could be significant. I currently do not recall the numbers from the previous scenario, but I might be able to share it. But it is in our previous report in detail. As for the policy, I can say a few things, and Mr. Nahapetyam would add. Said that in all our scenarios, this is considered as more of an adjustment, a normalization, especially what's presented here. And the main assumption is the macroprudential policy for containing risks was in the past mostly for managing those risks, that with those potential scenarios, if it's different from the one we described, then the risks would be covered. It's related to the counter-cyclical buffer, the LTV, especially FX lending, the restrictions on FX lending. All of those were aimed at mitigating these risks or absorbing these risks under severe scenarios. The financial system being ready to absorb them, but in all our observations, it really presumes a gradual, steady adjustment. I described why we think the adjustment will be seamless, the shift from Yerevan to the regions, and the problem that this program is not stopping. There are underlying programs that still continue, and it's going to continue. So we trust that this adjustment will be more seamless. Regarding the potential, of course, when we say potential, we rather mean GDP and demand rather than the growth environment. You pointed your criticism in a way as we'll take on when we talk about the level of growth. We can say that growth is close to potential. It might not express what we wanted to say, that the demand environment is inflation neutral. In the structure of growth there are problems, there will continue to be problems, and even the growth potential is 5 to 5.5. Potential growth for Armenia is 5 to 5.5%, but we recently had higher growth than that, but we keep saying that the gap is closed, which is illogical, but that's actually what reflects the fact that in this high growth, as we said multiple times and we also say it today, within that growth the factors that concern the demand environment, the fundamental factors, have a much smaller weight. Within the 7 or 8% growths, even if they were most of it, they weren't all of it. There were short-term things and non-structural growth components, and if we take them out, we would have a better picture of our correct growth potential, whether we're close to it or above it for a given environment. Thank you for the questions. Mr. Avitis said almost all of it about scenarios. As to real estate, you're right. Mortgage loans are not just for home purchases, many of them are for home repairs. We're closely watching those figures, including the December figures. Growth, as you said, was unprecedented. We understand clearly why. We discussed this in the board, and at the moment we need a little bit of a pause there, because we know that the income tax refund program is moving from Yerevan to the regions. We need to see what demand forms in those regions, what demand for mortgages, so we can make a more clear assessment. Do we need the macroprudential tools here or not? The macroprudential tools and the toolkit is quite extensive, but it's really falling more under the financial stability mandate. At any time, whenever we look at price stability and financial stability issues, we always combine our calculations and scenario analysis. Mr. Avetisan mentioned this already. With LTV, we can make some adjustments, and we once did already. The counter-cyclical capital buffers discussions are held regularly, and it's a very good opportunity after that decision, to make a release to present where the board stands. In the near future we'll do that once again. With certain developments, they will be reflected there. Let me add regarding the scenarios, although Mr. Avetisan said almost all of it. These are all typical scenarios. They contain no signals regarding the balancing of risks. They just describe the judgments underlying the scenario. They're a combination of internal and external demand changes. A and B type scenarios, where the increase in demand or the decline in demand and their structure as to which part is driven by external demand, which part is driven by internal demand, slightly different between the A and B type scenarios. To be more specific, a typical A scenario is mostly the positive external demand scenario, and as you know, with the floating exchange rate, real exchange rate depreciation will automatically absorb external demand in terms of interest rates. There isn't much there to be done. Contrary to that, the B-type scenario, and there's the component of external demand there as well, but it's mostly driven by domestic demand. It's the scenario of declining confidence, so it's driven mostly by domestic demand, whereby the monetary policy response be somewhat greater. It's a pure difference in technical judgment, not risk, not any signal for or any impetus for balancing risks. Thank you for the presentation. As you said in your speech, the board is discussing ways to develop the GDP branch sector structure before year end. The projected GDP projection was around 7%, but at year end came in at 5.9%. And what's important here is when you look at the structure by sectors, the change in the IT sector, ICT branch, January-September, declined by 9.7%, but at the end of the year grew by 11.9%, so 21.6% adjustment, and that was an adjustment-related change. Its share in GDP was about, or contribution to GDP was about 1%. So I wonder how you explain the developments in this sector, whether the board discussed whether the board took these changes into consideration. So for instance, if had this adjustment not been made in the central bank's decision-making process, would it be the same in terms of monetary policy or not? We'll talk about GDP if Mr. Karapachan wants to add to your calculations, because he will give us the board's perspective on what its impact would have been. Let me start with projections. 7% was the target announced by the government, as we discussed many times. So in a sense, this is not at all a projection. The projections that we mostly use for our discussions were the projections of the financial market participants. And I quickly went over that slide, which was around 6% to 6.5%. After the latest indicator, you see the financial market participants also revised it downwards, which makes sense, which is reasonable. This was one of our signals. And then if you look at the numbers and the prediction, the forecasts were also around those numbers. And your question is whether there was a revision or a review of the IT sector's contribution. Yes, mostly and predominantly changes in the reports of the reporting entities if I recall correctly, or if I interpret this chart correctly, it's the 0.6 percentage points described here. It was roughly that magnitude of positive impact that contributed to growth. There can be different explanations, statistical explanations as well, as to whether this is comparable to the past year's indicators, but in terms of statistics, I think it's a proper and normal mechanism where reporting entities make changes in their reports, and they provide the more accurate growth figures. When we had the decline, and then the growth, it's not true we had a decline, but it turns out it wasn't a decline, it was a statistical error, and the reporting entities corrected it, so we had about 0.6% higher growth. As to growth, we have 5.9% growth. Even before this 5.9, we always talked about the structure of growth, the problems and the peculiarities. Not to say that this growth is good or this growth is bad, or just what is the better growth, but especially from the point of view of monetary policy impact on demand. Because if we say 8% growth, but then within that 8% growth 7% is some sort of a technical statistical mistake or a structural mistake or error, or because of re-exportation, which may have no impact on our demand, and it's important to know this for assessing monetary policy in the demand environment. When we say structural problems or short-term factors, problems in the structure of growth, it's mostly those that we talk about. We're now adding to them the perspective of risks, this potential risks of concentration related to construction. So all of these are structural problems, but this increase brings us back to the previous question where I said, why does this construction sector adjustment in terms of its macroeconomic or monetary policy decision impact, why it could be so much more, so much greater than if we didn't have this problem or the other problems of exposure to the real estate market. The two responses would have been different. So it is statistical, it is also structural. Those were the points we were highlighting. As to the developments in the IT sector, we're already seeing, and we're talking about the IT sector, we're seeing an adjustment in the IT sector. We have to probably accept and put up with it, or confront that. After a great demand shock, there's always normalization. So we had, for demand and for IT, we had a great shock, and then after that it normalized. And we talked about this in the past, the normalization of whether we grew and we stop. There's this one normalization scenario, whether we grew and we're going back and then stopping, and that's a normal scenario as well. When we say we grew too much, we grew too far. And now with adjusted statistics, we're closer to the first scenario, which I described, where we had strong growth and growth of the potential in that sector as well. And we understand that there was no surplus-driven growth, and there was more of a stabilization scenario than any sort of adjustment. So that's on the IT companies. I'll just add a very important observation. The central bank does not target growth or growth indicators. Of course, we consider it highly important, and in each cycle we pay close attention to GDP growth, economic activity index, and so on. Of course, our analysis is presented accordingly. And Mr. Avetisan mentioned this too. The sector breakdown is extremely important for us. This is exactly where we're also discussing for each sector, for each field, all the risks that we observed and their potential impact, and how these sectors, with the impact of these risks, could in one way or another influence our economic activity. And that's the main thing which the central bank is targeting, through which it is trying to achieve not just price stability but also a stable economic environment. Let me add something on the IT sector review. As Mr. Avetish said, it's a natural process, and with the current volumes of issuances reflect the current situation. But it's compared to the past year and the growth compared to the previous year, whether the previous year should have also been revised, then the growth would have been so large. Why this question is coming up, because when we monitor the IT sector developments from different angles, we look, for instance, at the growth of employment, registered workers, wage increases, or cash flows in the IT companies. We don't see significant growth relative to 23. So that's something, that's a hypothesis. Whether this review reflects real growth relative to the previous year. Outbrook investment company. I'm asking about the dollar exchange rate relative to the drum. If we look at the impact of external shocks, gradually declining in recent years, going back to the normal environment, going back to the normal flows of FX. We're still seeing relative stability of the exchange rate. Now, I want to know your opinion. How come? What is the reason for supply of FX? If parallel to this we're seeing a decline in economic activity or a decline in remittances from abroad. We had a shock. Our country got richer. Relative to that, one of the wealth indicators, real exchange rate, should have appreciated, and we saw that. Now that we discussed this, the question is what's going to happen in the future. Are we going to go back? If I understand the context of the question, are we going to go back to where we were? Well, the only likely scenario of that is if we go back to where we began, in a sense. So our current economic growth, even if we talk about growth slowing down, we're talking about growth. We're not talking about contraction, or we are speaking about slower growth. Growth still continues, so we continue to become still richer, not get poorer. So that's the comparison we should draw in that context. In any case, when our growth, even small, if growth is driven by our tradable sector, that means appreciation of the FX market, even 0.1. If we look at the longer term, then of course our tradable sector is not enough. In the longer term, you have to look at our relative trading partners, and that's the other one, productivity wise. So our potential, if our potential is high, potential growth is high in the tradable sector, than that in our trading partners, then in the long term, again, there should be an appreciation trend. So that's, if we're trying to ask what changed is that we're in a new reality. We're not seeing it. We're still not seeing any turning around. Taking me new shocks. Regional and others, and we can go back and there can be decline in wealth, change in the exchange rate, yes, obviously yes, and that's the angle at which we should approach this problem. And I mentioned some scenarios, but the current developments, there are no actual current stage developments that give us any indications of that. Those things, notice about consistency for us is related to the market expectation scenarios. It's comparable to the scenarios described in their scenarios by the market participants. If it's going to be the appreciated exchange rate trajectory, at the much slower growth, slower or steadier depreciation than compared to the US growth, is more of a depreciation scenario. Even the market participants could have that breakdown depending on growth, developments of the tradable component. Chandel investment company. Under your scenario, this year, the state budget was going to have a deficit this year. I wonder, covering that deficit, would it be from the domestic market or the external markets? And if it's going to be from the external market, what is the projected interest rate? In the draft budget, those things actually get presented for what they think, how much they think should come from internal sources, how much from external sources. I could be wrong with the numbers. It's both. To the external sources, that there was a message already about the Eurobonds recently. The Ministry of Finance can provide details of that later. I think the Minister of Finance also, the Minister of Finance indicated that the interest rate is around 7.1, 7.15, and that's really the benchmark interest rate for foreign financing. In a strategic sense, obviously, in terms of external debt, I'm quoting the debt management strategy of the finance ministry. It will be under market mechanisms, so the interest rate mechanisms will be closer to the market interest rates. Eurobonds are an indication of that. Under the debt management strategy, concessional loans, but this can be a benchmark for foreign debt, external debt. Just 2 words on this. As this is beyond, public debt management is beyond the central bank's mandate, it would be inappropriate for us to make any projections, and I think that the finance ministry colleagues over time will explain. Not Franken, Kvadrat, Bega, Armenia. As to the survey data, you presented the latest results. About 3/4 of the market participants expect at least 2 deductions before the end of the year, and about half of them expect 3 deductions. In terms of decision making, about the upcoming, how is it going to influence decisions that are going to be taken? And you said that the GDP gap is estimated at close to 0. But in the transparency report, board members have said the gap is negative. Is it a shortcoming in statistics, or is it inconsistency in assessing the potential? In one word, is the current interest rate more neutral or more expansionary? This is something we regularly conduct, these surveys at a certain frequency. Based on this decision, the communication, the discussion, the market reaction, then ahead of the next decision we will have the new one, and some things may change here. But then, is the board viewing it? Yes, of course. The board is viewing it exactly from the point of view of our framework, and it is as follows. This is the reference around which we built the discussion of all other scenarios of the board. Whether the central bank needs to nudge the market. It's important for the framework. I'm not saying, oh look, this is what they expect. To understand whether the scenario reflects all our risks. For some risks we need to point out. I say these risks need to be evaluated. They're going to be important. This is logical, so it's a bit mistimed. It was important. All of this was important for the previous decision. That's on your first question. You mentioned that board member was not here to explain what they meant, but I think he did give some explanation there. And that was his assessment. Naturally higher because in the current growth, in the components of growth, the parts, in his opinion, now I'm interpreting his decision, in his opinion, the demand components are less expressed, given also the structural specificities that I described, that the current growth or the recent year's GDP, in his opinion, there was that's the basis of our policies and the effectiveness of our policies, and also that's the reasoning of our decisions. I'll pick up where my colleague stopped. We have the transparency report, so we can also You see the healthy discussion atmosphere that we have in the board. And the board members also have some differences in opinions, which is clearly reflected in the one-pagers. Their assessments of risk. But then if you look generally at our press statements, press releases after the session, you'll see that as a result of our discussions, we reached final consensus that risks are balanced. The events are unfolding so fast that when we start the cycle, by the time we get to the interest rate discussion, the assumptions that were made, the core assumptions that were made for the one-pagers, in a way they're already changed, or their weight or relevance has changed. So that's why you're seeing the whole life discussion arriving at this. I think policy-wise we're more neutral. How much are we governed by expectations? To the extent that it is key elements for our overall policy framework. The market expectations are very significant for us. However, it's not like market expectations guide our decisions, govern our decisions, as Mr. Abeti says it. We compare all the arguments, all the factors, external environment, developments of the Armenian economy, inflationary expectations, surveys, many other arguments. Market expectations are an important one. Agbo Bank, thank you for the detailed presentation. I have two questions. First, coming back to the real estate market, a clarifying question. The central bank, for several quarters already, is considering the B scenario, overheating in the real estate market, and the adjustment leading to an impact on construction and the related sectors in terms of containing demand. Nevertheless, the central bank latest assessment on deviation from the fundamental prices in real estate was published in 2023 Q4, I believe. I'd like to know whether, considering that under the B-type scenarios there is still an overheating process, I would like to know whether the central bank is still relying on that estimate in building its scenarios. If there is a newer estimate that can be published, I would like to hear about them. And the second question has to do with the A and B type scenarios. You say they're typical scenarios, nevertheless it would be desirable also to see for all types of scenarios, no matter what the risk statement says, it would be good to see the likelihood of the scenarios materializing as a separate estimate, because they're not equally likely and they depend on economic variables and the monetary tools, and they're be good to see an assessment. These impulses are taken as a basis for building our own stress scenarios. Thank you. Thank you. I smiled at the end because we agreed that we'll talk about the framework in great detail, because the last question really concerned our new system and the scenarios and the role of the scenarios. So I'll speak a bit about it, but then certainly we'll have a chance to have a much more detailed discussion of this, because it's very important for me that the market participants have a very good understanding of why these scenarios, or what these scenarios are serving. Our framework working in an environment of uncertainty with the highest uncertainty, the likelihood of all scenarios is equal and close to zero. I'm not saying anything theoretical, but multiple scenarios all being likely close to zero, or uncertainty is when a couple of categories of scenarios have equal likelihood. The choice of scenarios that ends up in our taxonomy, they're not just evaluated by likelihood, and the board looks at countless scenarios and comes up with a smaller group of scenarios. It's based not just on the likelihood of probability, but also if that scenario materializes. But the magnitude of the macro impact on the board's position. There may be scenarios there where likelihood may be zero, but then from the point of view of the board, its impact on the economy, in the opinion of the board, is a lot greater, a lot more important, therefore, to understand and to manage the macro impact than a scenario the likelihood of which is 75%, for instance, but there's really not much of a need to manage that. So going back 2 or 3 rounds, that was exactly the situation. When the board spoke about it in its statement, and it said we have a group of B-type scenarios, the likelihood of which is very high relative to I-type scenarios, but then from the point of view of our decision, the macroeconomic impact of the A-type scenarios and our fears regarding the macro impact of the scenarios is much more alarming for us, and that's why our decision balanced the likelihood of one against the fears over the other. That's why, if we look at the probability of scenarios, whether they would give us any sort of an impulse, there would be a wrong impulse, because the second component would be omitted. That's why we leave the scenarios, but then in our communication, if you watched our communication, our press release, which is the board's biggest tool for communication, from all those scenarios, the board singles out certain scenarios. If you look at our latest, clearly mentions under A and B, there were scenarios that, for the decision taken yesterday, in terms of the likelihood and the impact, it was considered as the more important one. Not important, but important for the purposes of that decision. And the others are also very important ones, that large number that could exist. So in our system, this probably could be more of a problem than help. And in the real estate market, given the assessments, I'll point out again, from the point of view of monetary policy, we're not talking about the crisis scenario, but about the proper adjustment scenario and its macro impact. To draw a parallel, and I may be repeating myself, in 2008, this scenario would not have been on our radar perhaps before 2008. Its impact on demand, it's on the radar because with the proper adjustment, no crisis, no high shock, no high demand, if you consider this an adjustment, on that backdrop we could have the macro demand impact in terms of wealth and demands, but that's why these scenarios ended up here. Not because we were afraid of problems in that market, which is also to be addressed by macroprudential policy. And we see in the macroprudential reports that they're covered, they're discussed. In terms of the gap assessment, I personally probably cannot answer why the macroprudential assessment did not get published after that, but those are the same assessments, not saying it was going to be a huge adjustment, but this was one way for us to try to give a signal that in that market, when we assess the risks, that's what we took as the reference point. So the countercyclical buffers, the LTVs, and the other tools, that was the scenario that we used for that type of judgment. The real world, definitely greater than that, smaller than that, much smaller than that, or maybe not even that. But when you evaluate risks, to be able to make judgments on the countercyclical buffer, its magnitude, and the risk that you want to absorb, that's the one that was taken as a reference point. Possibly somewhat overestimated, possibly underestimated, but that's the reference point for the macroprudential determination. Beyond that, what changed, what added, what came out, this is something I currently cannot say. We probably will have for the macroprudential decisions, the press conference, and also you'll be able to work with our colleagues. So you can mention this, Mr. Arpich could possibly add. Thank you, High Cloud, Incor Investment Company. Speaking about economic concentration in the economy, you mentioned that construction and the financial sector are now interconnected. The income tax subsidy in Yerevan will now stop. I wonder if you think that this could help, or this could contribute to slower growth, or this could now shift growth to the regions and have more construction happen in the regions. Thank you. Thank you. The assessment of concentration, again, to arrange the questions properly, let me just reiterate. The assessment of concentration is important from the point of view of macroeconomic policy for us to understand what in the current growth, what is the share of the components that constantly and fundamentally contribute to the demand environment. That's why we discuss it. The greater the concentration, the lower that phenomenon. That's that context. But then, as to the outlook, we reach the real estate market. A year ago we talked about the same types of phenomena. This was more of a question mark. Is it going to shift to the regions or not? Will the other programs continue, like the mortgages? Will the mortgage programs continue? Or are we going to see a sharp change there over time? And in our current discussions, we get more information telling us that that is true. Some of that growth will shift to the regions, and if you extrapolate, maybe also fully substitute. So it's a normal process, because in real life we see that it is happening. A year ago we were skeptical about it, or it was a hard, unlikely scenario. We now see this is happening. Same, is it going to be at the same speed or full substitution? Again, it's a question of scenarios. If you extrapolate, it will somehow neutralize the event. And the next one about mortgages, what the data was showing, we had the mortgage growth net of December, and then after December we would have had that decline, but the big question was where, at 0, at 100, at 200, where? What was the point? The first few months of indicators Arik mentioned the two, we saw this. Was it a catastrophe? Probably not. If you just look at the flows, we go back to the beginning of 2024. Of course, this could also contain some statistical bits. And in a few months, much more clear trends, slightly higher or continue to decline. And you will see the answer to the second question there about program continuity, whether it's going to be more smooth or sharp. At the moment, still, the impulses are that it's going to be smooth, but then you can see the trends. Seamless, less seamless or sharper. Not really, and then for the scenarios we see, it's likely that there will probably not be full compensation, especially if you look at 24 over 24 relative to historical levels. The regions have a great impact, and there's potential there to compensate. Our monitoring shows this. Thank you. I have two more questions. I want to know what you think on some potential developments related to fiscal policy and their impact. My questions are not seeking information for you to give us information, but I wonder what you think. Your estimates of neutral refinancing rates and the ensuing uncertainty and the real refinancing interest rate, which is built around that. So it's not very expansionary or contractionary. Now that uncertainty around the neutral interest rate recently tends to decline. So the neutral refinancing rate has actually been tending to decline. If you look at the breakdown, it's mostly due to lower inflationary expectations. My question is this. Let's assume that the geopolitical and regional and domestic economic uncertainty that exists, but continues in the near future, in the foreseeable future, and the board continues to decide to keep the interest rate close to neutral, but then the latest fiscal impulses and the expected more aggressive fiscal policy in 2025, higher transportation prices and so on. I understand that their share in inflation is much smaller. I'm not asking about actual inflation, but the inflationary expectations. Because the public will think of higher transport fares and cyclically might generate inflationary expectations. But the increase in the turnover tax could create some inflationary expectations. On an anecdotal backdrop, this is already being seen. These expectations go up, and the neutral interest rate also goes up, and the board were to decide to increase the interest rate. I wonder, wouldn't it be hard to communicate? I mean, how would you explain that this hike is not because some risks have materialized, but that you want to stay around neutral, because this is the current neutral. Until now it was easy. Neutral goes down, you go down. And it's about balancing the risks. So it was easier. Is it not going to be more difficult for you? Do you think the communication is to happen somewhat differently than capital expenditures? Your numbers are also showing that relative to GDP there's an increase in capital expenditures in recent years, and there's a further planned increase, but a big chunk of that increase is aimed at security matters. It's really not about boosting demand or potential GDP. No major impact in those terms. So no inflationary expectations there, but vice versa. And I wonder whether the fiscal policy and the expenditure policy effects could materialize. One is happening through expectations, the other one more through the wealth effect, or the potential effect. But will the two counteract generally? And my other question has to do with fiscal policy of the US. I'm just curious what you think, but migrationary policy in particular, and if the US keeps its promises and continues to deport migrants, those migrants who were from Armenia. What's your estimate? I mean, how many of them, what productivity? How many of the migrants will come back to our economy, and their impact on aggregate demand and the country's productivity as well? Thank you. Thank you. On the neutrality, as you interpreted very well how we're going to communicate, and you understand this very well. That's the basis of our communication. We have the highest transparency, discussing it with the people, with the professionals. The neutral rates aren't communicated to the public at large. It's for the professional community. So just like you presented, that's how the communication will take place. And as I told you, there was the inflationary expectation chart. The uncertainty bit still is left open. That whole time the uncertainty bit was not covered, and we said this in all of our communications. Whether it's transportation, butter, wheat, any other shocks, political, non-political, dreams of people, whatever shocks leading to inflationary expectations, uncertainty suddenly turning into high inflationary expectations, yes, then yes, we would need to act there. Not just watch the neutral and stay neutral, but also need to contain, because we want to bring the expectations close to reality. We're going to not only watch the neutral, and the neutral will climb up as well, but we will further go above the neutral rate so as to contain it back. We've always done this communication, we'll continue to do it. Inflation expectations. As to the uncertainty regarding the neutral, if you look at our minutes, the transparency report that came out yesterday, you can see that for this neutral, the GDP gap within the board, there's a different perspective, and that the neutral interest rate should be much higher. And it's a reflection of existing uncertainty, and those are the reasons related to uncertainty in the US, related to our potential, and so on, different reasons. Plus the risk premium. I spoke about the geopolitical risks. I said in my presentation, when I spoke about the country risk premium estimates, I said that in all our assessments, worldwide and for ourselves, it's currently assessed as quite low, given the geopolitical uncertainties. And so in our scenarios, in the A-type stagflation scenarios, the upwards adjustment risk scenario lingers, and it's quite present. It's even pointed out in our press release. So that scenario stays. Risk premium, they're less neutral, and our policy as a compilation of A-type scenarios is an important scenario. So capex, budget capital spending, naturally yes. That was the purpose of presenting these scenarios, and we said we have capital expenses, and there's a bit there concerned which has no economic effects. If we take it into consideration with the budget deficit, with that same scenario, the impact on the economy would not be expansionary. The impact should be found, and if we add also to that scenario can we talk about the neutral? Probably yes. But it would be more of a neutral position if we compare the two. But then why do we differentiate? Because in the context of risks, we're talking not about the most likely scenario in the context of risk discussions. It's important that the board, with its communication and what you're reading, you see exactly which is the direction of concerns. It's the monetary policy. I remember there was a bit of that question that I wanted to discuss. All the scenarios which are described, and this is important also for how you read our reports. So it's better you read it. The part with the scenarios, this is the one. It is in the report. All our scenarios are divided into 4 quarters. So you can imagine the implication on monetary policy. A and B mean that one is higher, and the magnitudes all left, because we're talking about risks, the magnitude of risk, on the backdrop of uncertainty. You can add yours, we can add ours, it's always possible. But then there's the expansionary demand and contractionary demand components. Stagflationary. It's not necessarily a single direction, but then we arrange it based on how the board evaluates. There are many stagflation scenarios. But if the board has a clear stagflation scenario and a clear position about those scenarios saying that it will increase more than keep stable and avoid the stagflationary pressure and look through those pressures without responding to them, then there's a clear position there. It ends up in the right place, the A or the B. So the board's position on the scenarios, policy position, you can roughly see it in those quarters. I'm sorry for getting carried away, but I realized I hadn't given precise details of this as to the US's migration policy. Monitoring wise, actual real numbers, 0.1, 0.01. If we see that the amounts are getting close to the announced amounts, then the question would be whether it should be seen in the context of Armenia citizens. If you have 50,000 people coming from Russia, then if it becomes sizable in the US, then we might view it as a migrationary factor in Armenia as well. Regarding the numbers, as Mr. Avetisan mentioned, we're monitoring those indicators. I think the annual plan is 1 million of deporting illegal migrants, but they only did 30,000 in January, February, so if you extrapolate it over the year, it's quite far behind the annual plan, and it's comparable to the previous month's indicators. This policy is not expected to become more stricter, so the numbers are not sizable, so we didn't go into its structure. Because it was a good thing that in the past, the biggest year, which was actually under the Obama administration, even during that time, we did not see migration back to Armenia. The current plan is 3 times higher than the peak year, so even if it goes at that pace, we will still probably not see many things happening here. If it's 3 times greater, then there might be a slight effect, but at the moment, probably it's too early to speak about a major effect. If there are no further questions, we can conclude. Then please leave the cards with the police officers and go through this other door. Go out through this other door. Thank you. Thank you. If I may just ask for 1 second of your attention. This is off the record.